Welcome to Talk Tickers. Today we are doing a deep dive into the Q2 2025 earnings call for Vince Holding Corp. That's VNCE, reported post-market September 10th.
And we really have to start with the market reaction here. I mean, this stock just absolutely took off. We saw it surge over 80%, spiking even higher intraday, over 110% the next morning. Massive volume, too.
Exactly. That kind of explosion tells you something fundamental shifted. So our mission today, let's unpack what happened operationally to cause that kind of reaction.
Yeah, what levers did they actually pull to get this surprise profit? And how are they handling these, ongoing headwinds like tariffs and maybe some consumer caution?
Okay, let's start with the headline numbers, because they really set the stage for this divergence we saw.
Right.
On the top line, revenue, things looked pretty much as expected, maybe even a little soft. Came in at $73.2 million.
Which, was technically a beat, but just barely over the $72.9 million consensus.
And it was actually down slightly year over year, about 1.3%. So if you only saw that number, you'd never guess the stock would rocket.
No way. And that's why we need to dig deeper. The whole story really was on the bottom line, execution.
Okay, lay it out for us.
Adjusted earnings per share, EPS, came in at $0.38. Now remember, the street was looking for a loss of $0.08.
Wow. So $1.46 beat per share. That's huge.
It's massive and driven almost entirely by, cost management and getting those margins right.
And that flows right through, I imagine. Adjusted EBITDA.
Nearly tripled. It surged to $6.7 million. Compare that to just $2.7 million last year. That kind of jump, it just doesn't happen by accident, especially not now.
Okay, so the market sees flat-ish sales, but rewards this huge bottom line improvement.
Exactly. It tells you traders believe management's found a playbook that works, right? They're rewarding that execution, that profitability floor they seem to have built.
Let's talk about that execution then.
Yeah.
Margins have to be the core here. Gross margin hit 50.4%. That's up, 300 basis points year over year?
Yeah, about 300 basis points, a really strong number.
How did they pull that off, especially with tariffs still being a factor?
Well, it seems like it was a multi-pronged approach. Management talked about three main things. First, better product costing, so buying smarter.
Okay.
Second, some strategic price increases. And third, this was apparently the biggest piece, much lower discounting. Significantly less.
Lower discounting. How much did that contribute?
That alone was about 210 basis points of the improvement, just cutting back on markdown.
They were still fighting headwinds, weren't they? It wasn't all smooth sailing.
Oh, absolutely not. That's what makes it even more impressive, I think. You had tariffs dragging things down by about 170 basis points.
Okay.
And then higher freight costs added another 100 basis points of pressure. So they overcame almost 270 basis points of macro headwinds.
And still netted 300 basis points of improvement.
Exactly. That's really strong operational work there. Heroic, like you said in the outline.
Now, we should probably touch on the GAAP versus non-GAAP EPS numbers, because there was a pretty big difference. GAAP was $1.93, way higher than the $1.38 adjusted.
Yeah.
What happened there?
Yeah, good point. That difference, that $1.55 per share, it boils down to one significant one-time item.
Okay.
The company received $7.2 million from the Employee Retention Credit Program, the ERC.
Yeah.
Related back to the pandemic.
The ERC money finally coming through.
Right. And that provided a big offset to their SG&A expenses on the GAAP books.
So for understanding the core ongoing business health, we really need to look at that adjusted 0.38 number. That $7.2 million isn't repeating.
Precisely. It's a nice windfall, sure, but it's non-recurring. What's key, though, is management did point out that even if you exclude that ERC benefit, their underlying SG&A was still really well managed.
So they were running lean anyway.
Yeah, they kept overhead tight, good expense discipline, even without the credit helping the numbers.
Okay, back to those margin drivers. You mentioned strategic pricing and cutting discounts. Is there a risk there? Pushing prices up, cutting deals. Could that hurt demand later?
That's definitely the question, isn't it? Cutting discounts by 210 basis points is pretty aggressive.
Yeah.
Management's argument is basically twofold. First, they say the price tweaks are surgical, like style by style, not just blanket increases, trying to keep that value prop. And second, their core customer tends to be more affluent. So the thinking is that group can probably absorb these price changes better than, say, the broader market.
Okay, that makes sense. It links back to where the revenue actually came from, which channels were working.
Well, The growth, what little there was overall, really came from direct-to-consumer DTC. That was up 5.5% to $28.5 million.
And you said that links back to the margin story.
Yeah, management credited it to successfully, and this is their phrase, elongating the full price selling season.
Elongating full price selling. How do you actually do that?
It sounds like a strategic inventory game. So instead of marking things down early to clear them out,
Right.
they timed things, maybe delayed some wholesale shipments to keep the good stuff in their own stores at full price for longer, maximizes the margin they capture directly. Ah, okay. So the flip side, that 5.1% decline we saw in wholesale revenue, that wasn't necessarily weak demand. It was partly intentional.
That seems to be the story, yes. An intentional delay in shipping some fall orders. It let them grab those higher DTC margins in Q2 and maybe Q3, using wholesale more strategically later on.
Smart if you're prioritizing profit and cash flow over just chasing top-line numbers.
Exactly. Especially in this environment.
Let's pivot to maybe the biggest operational challenge, tariffs. Management sounds really confident now. They expect to mitigate about half, 50%, of the estimated $4 to $5 million hit in the back half of the year.
Yeah, that's a bold claim, but it suggests their strategies are working.
What are those strategies? How are they doing it?
It's basically threefold.
Yeah.
One, moving production out of heavily tariffed regions, like changing the country of origin.
Okay, the obvious one.
Two, really leaning on vendors through negotiations. And three, continuing those surgical price actions we talked about. It's a complex juggling act, basically retooling the supply chain on the fly. And is this just a short-term fix, or are they making permanent changes?
This sounds more strategic, more long-term. They're actively trying to reduce their reliance on any single country. The target is pretty aggressive.
What is?
They want sourcing capped at 25% from any one country by holiday or spring 2026.
25%. Wow. What was it before? Wasn't it mostly China?
Yeah, apparently as high as 80% from one region, likely China, just back in 2024. So that's a massive shift towards diversification.
It implies they see diversification as key, not just for tariffs now, but for long-term stability, right? Avoiding that single point of failure risk.
Precisely. It might add some complexity or cost up front, but it builds a much more resilient foundation, learning lessons from the pandemic supply chain mess.
Okay, so they've successfully defended the margins, managed tariffs, and that seems to have given them confidence to switch gears a bit. Management's talking about reinvestment now, moving to offense.
Yeah, that's the signal. Shifting from pure defense cost cuts, tariff fights, towards investing for growth again.
And what does that offense look like? Where's the money going?
Two main areas mentioned. First, putting dollars back into top funnel marketing. They'd pulled back earlier to save cash. Now they want to drive awareness again.
Makes sense.
Second, continuing to build out their physical footprint. They mentioned new store openings planned for the fall in places like Nashville and Sacramento, kind of filling in geographic gaps, supporting e-com too.
All right, let's connect this all back to that wild stock reaction. Operational success is clear, but the Q3 guidance sounded pretty cautious, didn't it? Why the massive market reward?
Yeah, the Q3 guide is cautious. They're forecasting net sales basically flat to up maybe low single digits, like 3% max year over year.
That was margins.
Operating margin guidance is also pretty slim, between 1% and 4%, and they explicitly said they're taking a cautious view on our consumers, acknowledging the macro picture, even if their specific customers haven't turned negative yet.
So the market just ignored the cautious sales guide. They looked past it.
It really seems that way. The market appears to be laser-focused on the profitability surprise and the margin gains. The belief seems to be that this operational playbook is real, it's sustainable.
They prove they can control costs and manage the supply chain.
Exactly. They controlled what they could control. And you combine that proof with the fact they also reduced long-term debt, significantly down $23.3 million year over year.
Right. Strengthening the balance sheet.
Yeah. It suggests the company is just structurally healthier. So the excitement wasn't about the quantity of sales, but the quality of the earnings and the operations.
Okay, so looking ahead, key things to watch would be holiday sales performance, naturally. Does that marketing reinvestment actually drive traffic? And can they keep hitting those tariff mitigation goals?
Those are the big ones, absolutely.
All right, given everything we've discussed, the huge spike, the thin float, the solid operations but cautious guide, it begs the question of what happens next with the stock, which leads us perfectly into our next segment. But first, the necessary disclaimer.
Right. Absolutely mandatory. Look, we're discussing public information, the company's context, but we are not registered investment advisors. Nothing we say here is financial advice.
It's purely for informational, illustrative, maybe even entertainment purposes.
Please do not make any trades based on this discussion. Always consult with your own professional financial advisor before making any investment decisions.
Disclaimer fully noted. Okay, the setup here is classic post-spike volatility, isn't it? Stock rips higher, hits nearly $6 on huge volume. Underlying story is better, but the near-term guide is soft and the float is thin. Prone to big swings.
Definitely prone to swings, but given how well they executed on costs and margins, establishing that higher operational floor, simply betting against the company might be risky too. So maybe we look at it differently.
How so?
Perhaps a structured approach, something that targets the newfound stability, rather than trying to guess the short-term momentum or volatility.
Okay, intriguing. What's the outrageous but plausible idea?
Well, how about something like a short duration out-of-the-money put spread, maybe expiring after the holidays, say January 2026?
A put spread. Explain the thinking there.
The bet is essentially this. While the stock probably won't sustain that $6 peak given the cautious guide,
Right.
the improved EBITDA, the debt reduction, that whole improved operational floor we talked about, should limit the downside. It probably won't collapse all the way back to its old lows below $2.76.
So you're betting the operational gains provide support. Selling a put near the current price, buying one further out, defining your risk.
Exactly. You're playing the operational floor against the market's volatility premium, betting that internal efficiency provides downside protection, even if the stock cools off from the highs.
Interesting angle. Okay, that brings us towards the end of this deep dive. Let's do a quick recap. Key takeaways.
Number one has to be that huge non-GAAP EPS beat, $0.38 versus negative 0.8 cents expected. Just massive.
Driven by number two. Incredible margin expansion. Gross margin hitting 50.4%. Achieved mostly through aggressive cuts to discounting and some smart pricing.
And number three, the pivot towards offense after proving their defense. They're aggressively mitigating tariffs while starting to reinvest in marketing and new stores.
Yeah, the Q2 story was definitely about discipline and defense, wasn't it? Handling costs, managing tariffs, elongating that full price selling. They really showed they can execute under pressure.
They absolutely did.
Which leads us to the final provocative thought for you, the listener. Management proved they can play defense. Now they're pivoting to offense. The big question for the second half is, can that new marketing spend and the store rollouts actually translate that operational efficiency into renewed top-line growth?
Or will that consumer caution they baked into the Q3 guidance prove to be the real ceiling, limiting how much the stock can truly hold on to after this incredible run? Something to chew on as we head into the holiday retail season.
Indeed. Thank you for joining us on Talk Tickers for this deep dive.
We look forward to connecting the dots with you again next time.